Hi everyone. First, let me wish you all a very happy and prosperous new year. The topic we are going to look at this time is this: taper is here, where is the tantrum? Markets have a miraculous way to surprise even seasoned investors. This time it has brought this element of surprise by not playing to this usual script that normally unfolds during taper cycle. In this video, we are going to be discussing about this new dynamics that's playing out in Indian markets. So first, let's look at what typically happens in a taper cycle, usual taper cycle. FIs pull out large sums of money within weeks. Dollar index dances upwards, and while the 10-year US yield firms up with a strong momentum. As a result, emerging market currencies get battered, and consequently, you see a big crash in emerging market equities. This is what happened in 2013 taper cycle, and it took markets over 6 months to recover from that shock of taper. Now we are already in mid part of the taper cycle. Fed's unwinding of bond purchases already started from December. In fact, Fed has plans to double down on its taper plans, and they want to complete and conclude the taper cycle by March. And the first interest rate hike from Fed probably is going to be there anytime soon. And FIs are pulled out close to $8.5 billion in this quarter of October to December. Did we see a repeat of 2013? Surprisingly, markets have taken the entire shock in its stride. Look at rupee; it's in fact it has marginally firmed up, and Indian markets have barely budged. Small mid caps are hitting new highs. So why is it so different this time? As we see, there are multiple reasons for this, but the primary reasons are threefold. First, I think as a counterbalance to FI's exit, retail participation has become very strong, and strength of retail participation is one of the key difference what we're seeing in this cycle. Second, again as a counterbalance for FI's exit in secondary markets, you see a large inflows in the primary market in the quarter of October to December. Over $6 to $7 billion have come in the primary markets from FIs. And the third, which is again very important, is RBI's huge level of surplus reserves. That's in a way giving strength to RBI to manage the rupee without any major shocks. So in summary, by not playing to the usual script, markets have disappointed the bears hugely. Now coming to our last section, are there any major lessons for investors from this cycle, from this new dynamics? As we see, the biggest lessons one can draw from this change in the dynamics of the cycle is this: why trying to time the correction is so futile, unwise, and self-defeating for investors. I've seen a lot of investors pulling out money from their well-doing investments, anticipating a repeat of 2013 this time. Now that the markets have not given a window, and these investors will be forced to come back at a higher level at a much higher price. Staying invested through volatility is extremely critical for superior long-term returns. This does not mean that the markets are not going to correct and it's going to be a one-way traffic. Not at all. Corrections are par for the course in any bull market, and we expect corrections on the way. The reasons could be different this time. We don't know what reasons. We'll know the reasons only in hindsight. Having said that, we expect the markets to turn stock specific going forward, and we expect the momentum and the actions to shift to the broader space from the large and benchmarks. And more you will find the large and benchmarks to consolidate from here on, and the action shifting to broader space with stock specific actions. There'll be huge opportunity for alpha generation going forward. Investors can look at underperforming sectors like pharma, auto, and print and media for value unlocking. As someone wise said, time in the market that creates wealth, not timing the market. With that, let me conclude this video. Happy value investing. Thanks for watching this video. See you in my next one. Thanks a lot.